Good morning, everyone. Okay, on behalf of Primer Brains, I would like to welcome each one of you in today's webinar. Thank you for taking time and joining us. Okay, before we begin with the technical sessions, allow me to briefly introduce to our organization and then our esteemed speaker for today. Primer Brain was founded in Dubai for 14 years ago by the professional, qualified, and experienced business advisors. Since then, we have been actively engaged in audit, assurance, tax, accounting, finance, and business consultancy services for the client across various industries. Today, Primer Brain is headquartered in Dubai and has expanded with office in Abu Dhabi, Sharjah, Oman, and Saudi Arabia. In Dubai, we have 5 partners of one director with extensive experience in audit, tax, and advisory. Now, let me introduce to our first speaker of today's session, CA Darshini Gohil. Darshini, she is a chartered accountant with over 13 years of experience, specialized in corporate tax, international tax, and transferring price. She has been associated with leading direct tax litigation and advisory firm. We are delighted to have her today. Our second speaker for today is CA Hussain Bhanpurwala. He is a corporate tax and transferring pricing specialist with over 10 years of experience in delivering advisory, compliances, restructuring, permanent establishment analysis, wide support, and high impact assessment and implementation solution for diversified business groups. His experience made today's sessions even more valuable for all of us. Let's start the session today now.
Thank you, Vidhi. Thank you for the lovely introduction. Very good morning to all the attendees and Ramadan Kareem to all those who are celebrating. Quickly beginning with the session. In the first half of the session, we'll be dealing with advanced pricing agreements in the UAE. And I'll quickly set the agenda for the day. In this session, we'll be covering the following aspects. Primarily, we'll be dealing with 6 aspects. Firstly, we'll be dealing with what the UAE framework on advanced pricing agreement is. Then I'll be deliberating on how or what will be the right APA model which the entity should choose if at all it wishes to go for an APA agreement. Thirdly, we'll discuss the eligibility criteria, threshold requirements which are given in the law, which makes an entity or a company eligible to go for an APA agreement. Fourthly, we'll deal with the covered period applicable fees. And then most importantly, we'll navigate the process of APA from pre-filing to conclusion. What will be the information required? What will be the various timelines? How long the process will be? As to now, immediately what UAE taxpayers should expect and what they should work upon if at all they wish to go for the APA regime. Moving on to the next slide. So advanced pricing agreement in the UAE. As we understand in the corporate tax regime, whenever the word transfer pricing comes, there comes in the mind a very big question of certainty. Transfer pricing being a very subjective affair. Therefore, there has been a provision in Article 59 of the UAE Corporate Tax, wherein a taxpayer can apply to the FT authority to get certainty in respect of related party. So just defining a tax authority, wherein they predetermine the arm's length price in respect of certain related party transaction, either domestic arm's length price has been decided. It provides tax certainty to the taxpayer. The policy and intent of the APA regime is basically, given to strengthen the tax predictability. It fosters investors' confidence and also aligns the framework of the UAE corporate tax law with the international and the international best practices, wherein we have APA practices in other tax jurisdictions as well. Given that transfer pricing is such a subjective matter, and also reducing the feasibility or the probability of the entity getting audited by the FTA in respect of its related party transactions and the margins of the FTA. Administrative ease of burden and ease of doing business in the long run. What are the key issues with respect to the APA? We'll deal with it in detail later on, but just to highlight in the beginning, we are dealing only with the prospective APAs as of now. That is, in respect of those related party transactions which have been already entered or which will be entered in future, only in respect of those related party transactions can the taxpayer opt for an APA. It is not related to any prior period related party transaction. Similarly, we have a very important aspect of proper information and documentation has to be kept by the taxpayer if at all the taxpayer wishes to go for the APA regime. And of course, the materiality threshold for going for the APA regime are quite high. So we'll deliberate them in the ensuing slides. Moving on to the next slide. The next slide important as to what and which type of APA or advanced pricing agreement the entity should go for. Just to about the types of APA as of now. Unilateral APA, bilateral APA, and multilateral APA. A unilateral APA is basically an agreement between the taxpayer and the entity in respect of either the domestic transactions of related parties or the cross-border related party transactions. The key feature of a unilateral APA is it is binding on both the FTA as well as the taxpayer which is being entered into the contract. And this APA, what we are dealing is APA. Bilateral APA is nothing of two jurisdictions. So here, what I think there's an issue with the voice. So bilateral APA is basically nothing but an agreement between two competent jurisdictions and two different countries. And it only covers cross-border control transactions. Multilateral APA, on the other hand, is similar to a bilateral APA with the only difference that it involves more than two tax jurisdictions. In some is in some other country, and the third entity is also in some other country. So if there are more than two tax jurisdictions involved, then multilateral APA comes into force. In the UAE as of now, the UAE has only implemented the unilateral APA, and the key issues to be focused on is this: the taxpayer has to assess on their own as to which APA would be suitable going forward. We do have a probability that bilateral APA and multilateral APA will also soon be notified by the FTA. However, the FTA is yet to announce on the same. Let's go to the next slide, please. Eligibility criteria and applicable thresholds. To begin with, I'll just focus on the limits for entities wherein they will be eligible to apply for an APA. For those entities which are not a part of the tax group in the UAE, the limit is at least arm's length value of all the domestic or either cross-border related party transactions should be at least AED 100 million. So it roughly calculates to approximately USD 27.2 million. And this should be for per tax period and at the time of application. Speaking for the limit of tax group, the limit basically remains same. However, here we have to be sure that the transaction has to be undertaken by the entities in the tax group. Those entities which are transacting within the tax group should. Speaking of the eligibility criteria, taxpayers with either existing or proposed domestic or cross-border related parties transactions are eligible to enter the APA. So as I've already said, APA regime will now focus on the proposed or prospective APAs. We are not dealing with any kind of prior period transactions or any certainty in respect of that. Similarly, domestic RPTs or related party transactions are only eligible when the transacting parties are subject to different CT rates. Like, for example, the entity is a mainland entity and it is transacting with an entity which is a free zone entity and a qualifying free zone person. So the mainland entity is taxed at 9%, but the free zone entity is taxed at 0%. So in that case, the transaction is eligible. Safe harbor transactions and those transactions which are intra-group services like low value adding services are not eligible for APA regime. We have different transactions wherein a thin margin of 5% is added for low value falling in the ambit of the APA regime. And the most important point here to note is materiality threshold should not be the sole criteria of whether the APA will be accepted by the authority or not accepted. So we see that there is a limit of AED 100 million in the regime. However, the only thing which will matter in terms of getting your application accepted or rejected will be the specific facts, circumstances, and the complexity of the case. If the matter is already less complex, if it is already decided with respect to certain jurisdictions, then the APA application may be rejected. And more importantly, the arm's length pricing which has to be done should be done as per the own analysis. The limit of AED 100 million has to be taken care of by way of the assessees or the taxpayers' own analysis. So that plays an important role. Let's move on to the next slide. Now, covered period and applicable fees. These are just structural and regulatory limits which have been set. For the covered period, the APA should cover at least related party transactions of 3 tax periods. And the taxpayer can opt for an APA for a maximum of 5 tax periods. So as of now, any transaction covering for less than 3 tax period will not be allowed, and anything more than 5 period will not be allowed. Similarly, fees is for new application is AED 30,000 and for renewal application it is AED 15,000. Key point to be noted here is before applying for the APA application, entity should do proper cost benefit analysis as to where it stands, what it wants to achieve, and whether the entity's application will be accepted or rejected on their own thing. The role of the consultants and the role of in-house advisory teams becomes important here because they'll be able to gauge as to how an entity is placed suitably to either apply for the regime or not to apply, given the cost and benefit involved. Because the fee on both the aspect, either the new application fee or the renewal fee, both are non-refundable. Let's move on to the next slide. Now it takes me to the APA stages and process, which is the most important point here. We have 5 stages of the APA process in the UAE. The first stage is pre-filing consultation, wherein we'll be dealing with what necessary documents, what necessary steps, what impact assessments the entity should have in place, what functional benefits or analysis or economic analysis the entity should have in place to undertake the pre-filing consultation. Second stage would basically deal with the APA filing process. Thirdly, it will be the evaluation and negotiation with both the taxpayer and the FTA. In the fourth stage, we have basically the conclusion and implementation. And last but not the least, after the conclusion or the implementation has been achieved, how well we have to monitor and review the situation with each passing tax period. So quickly, I'll move on to the stage 1. For the sake of clarity and brevity, I have divided each stage into 3 steps or 3 buckets. The first bucket will be focused on the process of the stage. The second bucket will be focusing on the information which we have to fill in that stage in respect of any application to be made. And the third step and the third bucket, which is the most important one, are the timelines which the taxpayer should adhere to in the APA process. So let's focus on the information in the first stage which we have to fill. Basic information related to the group like group structure, overview of the industry and businesses, what all are the covered tax period with the entity is trying to cover in the APA, and the type of APA with the entity is selecting. As of now, we have only the unilateral APAs. However, we expect the FTA to announce soon the bilateral and multilateral APAs as well in line with OECD guidelines. And documents related to authorization like power of attorney, etc., are also required in this stage. What has to be done prior to this stage is we have to undertake a pre-filing consultation request. The assessee or the taxpayer has to file a pre-filing consultation request with the FPA in the prescribed form. After filing the pre-filing request, the FTA will review the application. And if the FTA have any additional queries or additional questions, FTA will get back to you with respect to those questions. And after the filing is done, after the additional information has been provided, to assess the suitability as to whether this application is eligible to be accepted or is not eligible, or it will be taken on an average for the pre-filing consultation stage. Whenever there is any requirement with respect to the FTA authority, it has to be adhered to, or it has to be replied to within 40 business days from the date of the requirement. And after the FTA has done with the suitability analysis, FTA will be coming back to the taxpayer within 60 days from the date of the pre-consultation meeting. Key important points to note here is any pre-filing consultation is not binding on either the taxpayer or the FTA. Therefore, entities which even have gone to the pre-filing stage are free to back out and free to withdraw the application. Similarly, FTA itself, if it does not deem you fit and suitable for the application, it can also reject the application and the matter closes. Some few examples of when an application can get rejected are basically any agreement or any contract for fixing the margin. If it is deemed to be having any tax avoidance effect, then it will be outright rejected. Similarly, if there are business fluctuations, laws of the UAE corporate tax law or the transfer pricing guidelines, then also your application can be rejected. Let's move on to the next stage. So in stage 2, we are primarily dealing with what the APA application filing process is. The process basically starts with when we have to file the application in the prescribed format. FTA and the applicant can transactions covered, and the application can either be in Arabic or it can be in English. Similarly, FTA is free to engage industry expert if the transaction is quite unique or if the transaction is quite complex. What information is required here? Basically, the value drivers, supply chain of the entity, and the key issues which are there with the related party transactions are covered here. All the related party details which are covered with the transaction has to be provided. And importantly, functional analysis has to be provided in a detailed format. Functional analysis will help the entity justify the role of the related party in the transaction. And importantly, it will also help to justify the margins which are being calculated in the related party transaction. And it will also help the entity in the long run to argue its case with the contract with the FTA on the APA regime. And last but not the least, we also have to furnish the group master file and local file if at all they are applicable on the entity. Again, the same time limits are there. Any response or any additional information which is being sought by the FTA has to be responded to within 40 business days. And the APA application must be filed within the earlier of 2 months from the date of FTA approval or 12 months before the commencement of the first tax period. We are dealing with some key issues of the second stage, which is there in the ensuing slide. So speaking of timelines, we dealt that the timeline to file the application is within from the date of approval or at least 1 year before the tax period. So just to explain it in a brief and concise manner, we have given an example which is in the last bullet point. If the pre-filing of the entity is approved on 30th November 2026 and the application relates to FY 2028, then the APA application should be filed by the taxpayer either between the earlier of either of the two dates. First date being 31st December 2026 and the second date being 31st January 2027, whichever is earlier. Similarly, if the transaction or if the period is FY 28-29, the APA filing date would be earlier of 1st April 27 or 31st January 27. One important point again has to be noted here is FTA may record the sessions and meetings, and it is not bound to share the minutes of those recordings and sessions. Similarly, if the FTA wants, it can also ask for the past 2 years information in respect of the arm's length analysis to figure out the APA regime or to figure out the APA agreement. Therefore, the entity not only has to prepare the documentation and the impact, etc., and the benchmarking studies, etc., for the relevant tax period for which it is applying, it also has to provide and also may be required to provide any information at least even prior to the date of the tax period of the APA prior to 2 years. And information and all the interviews will be conducted in English. If Arabic support is needed, FTA will be provided the same. Let's move on to the next slide. Here we are discussing the third stage of the evaluation and negotiation. In this, basically, once we have filed the AP application, the process of deliberation and to and fro between the team at FTA and the taxpayer begins. So basically, it will be the evaluation of the arm's length price, all the functional analysis, all the benchmarking studies which you have provided with your application. If FTA have any query, it will shoot the request to you, and that has to be responded within 30 business days. So there's a slight change between the timelines which were there earlier to respond and the timeline which is there here to respond. Earlier, the timeline to respond was 40 business days from the date of request. However, the response here has to be given within 30 business days. And the key considerations which we'll like to highlight here is APA is a very long and lengthy process. Negotiation, to and fro, deliberation can take years. So on an average, based on international experience, it takes around 40 months. So taxpayers should keep this thing in mind before planning and before applying for the AP regime. And even if acceptance of the application does not guarantee that you will be given the APA agreement and you will follow the implementation stage as well. If the application has been accepted, it might be rejected later on in respect of any factual contract discrepancies, any questions on the business conduct of the transaction, or with respect to the weak economic analysis. With this, we move on to stage 4. Stage 4 is just generally the conclusion and implementation stage. There is no specific timeline with respect to the stage. However, the key point and consideration to be noted here is any withdrawal of the application at this stage is actively discouraged because there is no fee refund. As we've already stated earlier, before applying for the FTA APA regime, we have to be sure that we have to be undertaking the cost benefit analysis and the impact study of whether we should apply for the APA or not, because the application fee will not be refunded. Let's move on to stage 5. After the APA has been approved, the process does not stop. Most taxpayer would think that once the APA has been agreed, taxpayer is in consonance with the FTA regime, then the process ends and there will be no future litigation and compliance. However, the APA process, even after the implementation, goes on, and we have to constantly monitor and review the situation. We have to be compliant with respect to our audited financial statement. We have to file an annual declaration, which has to be filed within the earlier of 90 days of APA signing or tax return due date, whichever is earlier. And the APA regime, as I already said, does not stop once the application has been filed and accepted. Once the application has been filed and accepted, we have to constantly monitor our situation and also keep complying with the annual declaration of the FTA. With this, we move on to the next slide. Speaking of APA, what would be the way forward for UAE taxpayers? The first and foremost and the most important point is to identify eligible transaction and assess the transfer pricing risk. Transfer pricing, as I said, is a very subjective matter. It involves a lot of assumptions and presumptions. However, Whether those assumptions and presumptions land rightly with the FTA's point of view has to be taken care of. How we can achieve that? We have to focus on transactions which are complex. Transactions related to intellectual properties, intangibles, royalties, fees for technical services, cross-border transactions with related parties and headquarters are some transactions which involve constant and complex deliberation. Those transactions can be looked upon by groups to ensure that the APA regime is entered into, to ensure that we are into ease of doing business, and we can carry on the business without having to fear any administrative penalty or any lack of certainty in respect of the transfer pricing. The second point and the second way forward would be to strengthen the documentation and forecasting of the entity. As already said, APA is a long and arduous process and depends upon a lot of heavy paperwork and documentation. Things like functional analysis, economic analysis, benchmarking studies, margin analysis, margin computation, segmental reporting, all this becomes very, very important. And these documents play a very pivotal role as to deciding whether your application will be accepted. And even if accepted, whether your application will go through and you will be concluded and implemented with the APA regime. It requires for extensive substantiation and also future projected transaction. So these things have to be kept in mind with the entity. And thirdly, planning early is the utmost key here. As already said, the timelines are very short and the process is very long. Therefore, to undertake such a long process, we have to ensure that we plan early. The preparation has to start in advance, considering the 6 or 9 months of pre-filing window. And we also understand that we need to file the 12 months before the first tax period. So that timeline is very short, because once the pre-filing implementation is done, you have a very short period to file the application. So if the planning is not done well in the very advanced stage, we may not be able to comply with the deadline of filing the application in the first hand. Therefore, planning early and respecting and adhering to APA timelines becomes important. Last but not the least, we have to ensure stability of critical assumptions, and APA regime can help align the group's policy with the group's global policies. Therefore, we also have to give in a if we remember, in one of the applications we have to give the group's local file and master file. Therefore, whatever is the group's corporate policy and transfer pricing policy at the global level has to align and has to be taken into consideration while also applying for the APA regime at the UAE level. Therefore, if there are any inconsistencies, that has to be ironed out. And once the application is filed and approved by the FTA, it ensures stability of operations and certainty on the part of the taxpayer. With this, I conclude my session on APA regime, and I hand over the podium to my colleague, Ms. Darshini Gohil. Over to you, Darshini.
Thank you, Hussein, for the insightful session on advanced pricing agreements. Hello, good morning, everyone. Ramadan Kareem. It is great to have you join us today. Please just let me know if I'm audible via the message, the chat box. Okay, great. Fine. So, in this next part of the session, we will be focused on the UAE's domestic minimum top-up tax, which has been introduced under the OECD Pillar 2 framework. Now, the goal is to make this practical. What is DMTT, who it applies to, what you must file, and how the computation will flow from the financials to the top-up tax. Now, let's start with agenda so you can see the journey we'll follow. So here's how we will run the session. We will begin with the overview regime. thresholds and applicability. Then we'll cover the compliance and the reporting framework, followed by the computation walkthrough with the safe harbors and transitional rules introduced under DMTT. And finally, we will also touch base on the OECD side-by-side package, which was announced in January 2026, and we can end with the readiness roadmap. Slide change. Okay, so let's start with the basics. How DMTT will sit inside the Pillar 2 architecture. To understand DMTT, we need to understand the Pillar 2 triangle of charging rules. There are three corners of the triangle. IIR, the income inclusion rule, UTPR, undertaxed payment rule, and DMTT, domestic minimum top-up tax. I think there is some issue with the video, the PPT. Yeah, I think it is visible now. Okay, so we can start again with this slide. Uh, so how DMTT sits within the overall Pillar 2 framework is that we need to understand that there are three corners of the triangle and how they are being charged. One is IIR, DMTT. In IIR, which is the income inclusion rule, the parent jurisdiction or the topmost parent company will collect the top-up tax which is not being paid on the low taxed income of their subsidiaries. As against this, UTPR is basically a backstop rule. So if the top-up tax wasn't collected under IIR, other jurisdictions can deny the benefits, deductions, or impose adjustments to collect the remaining top-up tax. Now, focusing on DMTT, which is being applied here locally in UAE, it charges the top-up tax itself on the low taxed UAE profit before it gets collected elsewhere. Now, you have to think of DMTT as UAE saying that if there is any pillar to top up tax related to UAE activities, UAE will want the first right to collect it domestically rather than that tax flowing to the other jurisdictions. However, we need to understand that this is only related to the activities which will be conducted in UAE or profits which are being generated in UAE. Now, to implement domestic top-up tax, there are two regulations at the moment that we can refer to. First is the Cabinet Decision number 142 of 2024 on top-up tax on MNEs, and this Cabinet Decision is aligned with the OECD Pillar 2 model rules. Second is the Ministerial Decision number 88 of 2025, which provides a commentary and agreed administrative guidance. So basically, ministerial decision number 82 is basically specifying that the OECD Pillar 2 models or the guidance which OECD has brought up specifically for DMTT, all of those will have to be read along with the Cabinet Decision number 142 2024. So Cabinet Decision 142 is not just an independent guidelines. You will have to read the OECD Pillar 2 DMTT model rules to apply this cabinet decision as well. So there, if there is some gap in cabinet decision, we have to consider the OECD guidelines also. Now, the UAE is granted the transitional qualified status. The screenshot of that qualified, the extract from the website is on the screen. Now, during the initial phase, UAE DMTT is treated as a qualified DMTT, which matters if you have parent entities in other jurisdiction, because that will reduce the risk of the another country collecting UAE related top-up tax under IIR or UTPR. Slide change. Now that we know where DMTT fits, the next question is who is in scope? Now, applicability is driven by two layers. First is the thresholds and the in-scope entities, and second is the minimum ETR requirement. Covering the applicability, we need to understand that not all M&E groups will be covered under Pillar 2. The point of Pillar 2 is that the M&E has to be a large M&E group. So the threshold which defines this is that uh, threshold for the consolidated revenues for the group itself should cross euro 750 millions in at least 2 of the last 4 fiscal years. And in this case, if your fiscal period is maybe less than or more than 12 months, the threshold can be proportionately adjusted as well. Now, M&E group, what does a group mean? Now, the group means that all the entities in the group included with the UP or the ultimate parent company needs to be consolidated line by line in the UP's consolidated financial statements. However, if, for example, if some subsidiaries are not included in the consolidated financial statements due to size or materiality factors, those entities will also be considered as part of an M&E group or a constituent entity of a M&E group. So this is on the M&E group. We need to understand that in UAE, DMTT is applicable for fiscal years commencing on or after 1st of January 2025. Now, if you are part of the M&E group, then comes the ETR test. ETR test is whether UAE effective tax rate for the entities in UAE falls below 15 million under Pillar 2 calculation. If your effective tax rate falls below 15%, automatically you need to now calculate the DMTT top-up tax. Which all entities are liable. So it's not just the subsidiaries which are in scope entities. In scope entities will also constitute permanent establishment, UAE subsidiaries, your joint venture and JV subsidiaries which are located in UAE, and your minority and constituent entities. We need to understand entities, permanent establishment, JVs, all of this, they have to be located within UAE to be considered as in scope entities. Now, coming to which entities are not covered or specifically excluded from DMTT regulation are the government entities, your international organization, your not-for-profit organizations, pension funds, and some investment or real estate vehicles at the UP level. Now, these all will be specifically excluded from the DMTT regime. Slide change. So now, if we understand if you are in scope, what are the compliance obligations and what is the filing requirement? To understand this, there are three practical compliance items which have been highlighted on the slide. The first is registration, second is DMTT return and payment, and third will be the Pillar 2 information return. Now, registration is a separate registration will be required for the in-scope entities and also for any domestic designated filing entities. It is to be noted that at the present moment, timelines and mechanism for registration are yet to be confirmed from FTA. However, businesses should not wait for the portal mechanics. If they are in scope and they are falling under the threshold limits which we discussed on the previous slide, they should get the data readiness done by now. I'm also sure that you will have to create a provision also for the DMTT before you finalize your books of accounts for 2025. Now coming to DMTT return and payment, the key point here is that DMTT return and notifications, the deadline or the due date is within 15 months of the end of the reporting financial year or fiscal year. However, for the first year, there is some relief given by FTA. The deadline is instead 18 months and not 15 months from the end of the financial year. Now we need to also understand that with the return, you need to also make the payment. So due date for DMTT payment will be similar to the due date for the DMTT return. Coming to the third leg of the compliance is the Pillar 2 information return. Now entities who are required to file this Pillar 2 information return are yet to be specified by the ministry. They will be specifying hopefully by this year so that we understand who all are covered here. The OECD, however, already has a standard template, which most likely will also be followed for the Pillar 2 information return or globe return as we know it in UAE as well. Now, the due date for the Pillar 2 return at the moment, it has been fixed at 15 months from the end of the fiscal year again. Now, when I spoke about registration, your DMTT return and your payment, we also heard about this term of domestic designated filing entity. So what is a domestic designated filing entity and how it differs from a constituent entity? So for example, if you are part of a large M&E group which has multiple constituent entities within UAE, your within your constituent entities, you can appoint a local constituent entity which will be doing the registration and the filing on behalf of all the local entities. So this way, filing instead of maybe two entities which are constituent entities can file a combined return and they can designate one of those two companies as a designated local entity which we can do the filing on behalf of both the entities. Now there is one more term which we need to understand is a designated filing entity, which is basically a group appointed entity which can be UP but not necessarily, that can file the Pillar 2 return, not the DMTT, the Pillar 2 return on behalf of the group. So as we understand, the biggest compliance risk we are seeing is not just the tax rate, it's also the ownership of filing responsibility when especially there are multiple entities which exist within UAE. Engine room of how this works. How the computation will actually flow from the accounting income to the top-up tax. So this slide is basically just a high-level roadmap. So in this, we can understand that we can go from the financial statements to the DMTT liability in 6 steps. So instead of going detail here, we can go to the next slide and we can start with the steps automatically. Now, before we get into more details, it is important to know that Pillar 2 return for DMTT calculation is both conceptual and mathematical and very nuanced. Since this is just an overview, we'll try to give an overview on the DMTT calculation, how the steps will flow. However, there are a lot of nuanced which we can cover later on as well. So the step one for your calculation is not your corporate tax return. You will begin with the net loss or income as per your financial statement prepared under acceptable accounting standard, which is IFRS. The acceptable accounting standard has included IFRS accounting standard as well, and then we have to follow the mandatory adjustments to align with the globe framework. Now, what are the adjustments? So basically, your not net income or loss will exclude certain or add back certain expenses like your net tax expenses, your corporate tax, withholding tax, deferred tax. You need to add it back to the income. Your dividend income, which has been included in the FS, your equity gains or losses, which are included in the FS, any prior period adjustments, your policy disallowed expenses like bribes, fines. So all of this policy specific policy disallowed expenses will need to be added back. Your qualifying international shipping income will be excluded, and there will be certain revaluation movements. Now revaluation movements is also subject to elections. And if you have elected for revaluation gains or losses, any adjustment related to those will have to be made to the pillar 2 income. The objective of this is to arrive at a standardized income or measure that forms the basis of effective tax rate computation. Now coming to step 2. The adjusted covered taxes. Now, what are adjusted covered taxes? So basically, when you think about adjusted covered taxes, you need to understand that these are the taxes which will be considered as you have already paid the taxes, and it will be considered while calculating the effective tax rate. But you will not just pick up the current tax or the corporate you need to adjust those as well. Now, when we come to adjusted covered taxes, we will begin with the current tax expenses as per the financial statements, and we will refine with specific additions and reductions which have been specified or prescribed under the DMTT rules. Now, what adjustments are covered? Adjustment will include certain refundable credits. You will have to remove taxes which are attributable to some income which will be excluded. You have to recalculate the deferred tax adjustments at the minimum rate, which is 15%, and incorporated taxes recorded in equity or OCI wherever relevant. For example, if there is an OCI adjustment, any taxes related to those adjustments will be incorporated in the adjusted covered taxes. And after considering all the adjustments, the result will come. What is the effective tax which has already been paid by the entity? Now, as a short note, we can just like highlight that covered taxes do not include the top-up tax of the parent entity under a qualified IIR, top-up tax accrued under another jurisdiction's qualified domestic minimum tax, taxes attributable under a qualified UTPR, any disqualified refundable taxes, any taxes paid by insurance companies that relate to returns to the policyholders. Now, why is this? Why we are excluding these taxes from the adjusted covered taxes? The rationale behind is to prevent double counting and to ensure that only genuine jurisdictional income taxes are included in the numerator of the ETR calculation. If any of the excluded items are mistakenly included, effective tax rate could be overstated, which could result in an incorrect DMTT outcome. Also, it is important to note that deferred taxes are included only to the extent permitted under Pillar 2 and are generally capped at 15% minimum rate. Slide change. Yeah, thanks. Coming to step 3, now that we have got we got adjusted covered taxes and the net Pillar 2 income. Once we have determined those, we can calculate the effective tax rate under step 3. Now this rate will be compared against the global minimum rate of 15%. Once we have the ETR in place, which will be of course below 15% to proceed to the next step. If it is already above 15%, you do not need to proceed. So once it is below, we go to step 4. Now, if you believe that, okay, 15% directly we need to put on the net Pillar 2 income is not correct, we do get some benefit in the form of substance-based income exclusion. Now, this exclusion basically allows a deduction equal to a specified percentage. Though specified percentage is a separate chart, we will come to the percentage later on, of the eligible payroll cost and eligible tangible asset carrying values. The intent behind is that if your constituent entities within UAE have genuine economic substance, some benefit, some protection towards that income is available through this relief. So once you apply the substance-based income exclusion, we determine the excess profit, which is the portion of income that remains and which is actually subject to potential top-up tax. Now, at this stage, once we have determined the top-up tax percentage, which is the difference between 15% and economic computed effective tax rate, we have to apply this percentage to the excess profits which have been left after the substance-based income inclusion. And then once we multiply this top-up tax rate to the excess profit, we get a DMTT liability in question, which needs to be paid to the UAE government. So this understand the mechanical computation, it is also important to understand that there are multiple elections which will need to be made while preparing the DMTT computation. Now the Pillar 2 allows certain elections to be made either manually or are fixed multiple year periods, typically 5-year periods. This elections can affect how Pillar 2 income is calculated. One example which I can give of the election is revaluation election, like how we have in corporate tax. Similarly, revaluation gains and losses, the election can be made, and accordingly Pillar 2 income will be adjusted, and those adjustments will need to be considered while doing the calculations. And we also need to note that these elections are not just some administrative formalities. These are actually computation choices which you need to make, which will affect your effective tax rate and the DMTT exposure as well. Slide change, please. Coming now that we have understood at least the overview of how the DMTT computational mechanics are working, I would like to also introduce a very equally important dimension. It is the relief mechanisms. So these reliefs are somewhat similar to what relief OECD has come up with. Those are safe harbor and transitional reliefs, which actually reduce your compliance burdens and deem the top-up tax to be zero in some cases. So we have summarized the reliefs in the slide. First relief which is there is your initial phase of international activity. This relief applies to M&E groups that are in the early phase of expansion. Under this rule, top-up tax is deemed to be zero if the M&E group satisfies two conditions. First condition, it has constituent entities in no more than 6 jurisdictions. And second, the total net book value of tangible asset across all the jurisdiction does not exceed euro 50 million. Now, this safe harbor is intended to support groups that are not yet significantly internationalized. It recognizes that early stage international groups may not have complex profit allocation structures. Second is your de minimis safe harbor. Uh, de minimis safe harbor allows the jurisdiction's top-up tax to be deemed zero if your average pillar 2 revenue for that jurisdiction is less than euro 10 million and your average pillar 2 income or losses less than euro 1 million. Now, the average we need to understand is computed over current fiscal year and two preceding fiscal years. We are almost due to time constraint. We can move on to the next slide. Okay, side-by-side regime. So, side-by-side package has been introduced by OECD in January 2026. Now, one important point which will affect UAE entities, which we can just highlight, is that in UAE, the safe harbor is available up to 2027-28. Now, that safe harbor has been extended for another year under this side-by-side package. One more important thing that side-by-side package has introduced is your SBS side-by-side safe harbor. Now, in this safe harbor, basically coming to the point, US has been designated as the SBS safe harbor, and IIR and UTPR will not apply to US based UPE. However, if your parent company, ultimate parent company is in US and they have been included in the SBS safe harbor, please note that if you are a UAE constituent entity, the safe harbor does not give you protection from DMTT. You will still have to apply DMTT top-up tax in UAE, despite the SBS safe harbor coming into picture. We can move on to the next slide. So these are the steps basically that are important to understand the compliance readiness from an organization's perspective. First, we have to understand from a business perspective what will be your in-scope entities, whether you have already taken the preliminary pillar 2 calculations. You need to see if you have some substance-based exclusion based on your payroll cost and based on the tangible assets which are there in UAE. You have to estimate your cash flow impact and you have to check whether any benefit is available to you under the safe harbors. You can also do structural planning in this, wherein if there are multiple constituent entities, you can evaluate whether you want to take individual registrations and return filing for all those constituent entities, or you need to consolidate under domestic designated entities. For qualifying free zone also, since qualifying free zone persons are also covered under DMTT, taking qualifying free zone benefit, you need to analyze whether if you want to go for 9% or if you still want to be under 0% regime. Now, compliance, you need to prepare for the Pillar 2 registration, your annual top-up tax returns and Pillar 2 returns if it is applicable. Now, when it comes to ERP and control systems, as you understood that tangible asset and payroll cost and all of this covered taxes and the deferred tax movement, these are all covered in your ERP systems, and maybe they are not that covered properly or with proper headings. So you may need to update your compliance and your control systems to ensure that all of this data are readily available for your Pillar 2 calculations. So once the compliance is done, we need to ensure that tax records for all of the compliances have to be maintained for 7 years from the end of the tax period. And what important records you can maintain are the computation, your reconciliation of Pillar 2 income, covered taxes with your financial statements and your return, what has been, your election register. So all of these records will be a part of your Pillar 2 file. So that for tomorrow, if FTA has any questions, those documents and all the calculations are readily available. Uh, One more thing I need to highlight that this session, even though it was just an overview on DMTT, it is in one of the series. Since this is a very vast topic and very nuanced topic, covering in half an hour is very difficult. And we will ensure that there are more such sessions on DMTT calculations, on your compliance and reporting framework going ahead. So if you have any questions, you may post the questions in the chat box. We can take it up. Uh, is this initial phase condition for UTPR or for all method? Uh, Julie, can you please clarify what exactly are you mentioning when you say that initial phase condition? So basically, if we need to understand that at the moment in UAE only DMTT is applicable. IIR and UTPR are not applicable under in UAE. So any safe harbor or relief or calculations are related to UAE constituent entities, and only the top-up tax for those entities have to be paid locally. Okay. Exclusion from UTPR of Emini group in the initial phase. Yes. For UAE, only DMTT is covered. So basically, UAE wants to evaluate how DMTT regime goes before introducing UTPR or IIR in UAE. So they will take a couple of years before they decide on this. Mr. Murli is asking, do MNEs need to pay 15% or 9% for tax? In the normal corporate tax return, you need to pay 9%. The top-up tax, which is based on the calculation, okay, do need to understand it may not be standard 15% also. It can be 14.5. Effective tax rate will include your substance-based income exclusions. So any top-up tax above 9% will have to be paid in the DMTT return along with the DMTT return. And those timelines are different. Of course, for the first year, for 25, it is 18 months from the end of the financial year. We have from Miss Hari Priya Suresh. So is this applicable to qualifying free zone company? If it is taxed at 0%, then top-up tax would be 15%. It is, yes, you are right. It is, the qualifying free zone companies are also included. Any substance-based taxed incentives are still not introduced. So qualifying free zone companies are included. Initially in the CT return, it will be 0. And top-up tax will be 50. It will not be 15%. It will be 15% based on the calculation of effective tax rate. Miss Miss Duyang Chaki, thank you. What is the initial deadline for Pillar 2 DMTT registration? Should we submit separate DMTT registration form before? Yes. Before the DMTT return, yes, you will have to submit a separate registration. However, the mechanism is still not out from FTA. So we will have to wait for some guidelines. They have not given us the deadline, but of course, hopefully within this year, we will have to register. We have taken up few questions. A few questions we will reply to you one on one. Basically, it's already 12:07. And if you do want to connect with us, our numbers are on screen. My number is also there. Hussein's number is also there. We both are very well aware about both Pillar 2 and DMTT and APA as well. You can connect with any one of us directly. Message us, call us, or email us. And for the other queries, we will respond to you in some time. So thank you everyone for your time and participation today. As we said, please feel free to reach out to us if you would like to discuss the impact of APA and UAE DMTT to your organization specifically. Thank you everyone.